Hi fellow traders, I'm making this video after daily closing of August 19. Yesterday's bullish breakout proved to be a false breakout after today's bearish engulfing candle. Despite yesterday's breakout was also very good. So now we have a bearish setup. If downward movement today was gradual and slow, it could be considered as just a retracement against this bullish rally, and then price could have a chance to continue to the upside. But having seen the today's speed of fall and the size of the candle, we can clearly see that yesterday's breakout, in spite of being a very good breakout, finally proved to be a false breakout, or you can say fake out. So now finally we have a bearish setup, and we have to find all the factors which are in in line with bearish context. So first of all, we'll look at the RSI 22. In my last video, I had discussed about RSI 22 and this overbought condition, which is why I was skeptical about further bullish development, and I had mentioned this as a big question mark on bullish context. So this played well, and market fell down from this overbought area. So this is RSI 22, and as you already know that I'm considering this 22 because there are 22 working days, almost 22 working days per month on average. So I want to understand the strength and weakness as per 22 days. Price was already overbought when this high was made. It had stayed overbought when this high was made. This high was kind of double top. This high was just a few pips above this previous high. That's why it looks similar to the previous one. And then RSI had made a lower high here. So if we look at the RSI and the price, we have slightly higher high, and then this higher high. So price made higher highs, whereas RSI made high, then lower high, and today we have this downward movement because of this price action. So this also can be considered as the recent RSI high. So RSI has been making lower highs, price has been making higher highs, which is a clear bearish divergence. So we have bearish divergence, we have false breakout, and now I will take you to 4-hour time frame to show you divergence on a bigger picture and rather clearer picture. So if we go to 4-hour time frame, there was bearish divergence ever since this high was made. This high was made here, then when this high was made, this was pretty higher than the previous high, whereas MACD had made a lower high. If you compare this versus this, then price again had made a slightly higher high, MACD made lower high, price made even higher high, but MACD made lower high. So MACD has been making lower highs, but price has been making higher high, which is a very clear divergence on 4-hour time frame. We, however, cannot take divergence into our account to consider a trade. We have to look at other factors as well. So we can't simply rely on divergence, which is why I do not simply take position just after a divergence has been made by the price. So, but yeah, it is a supporting factor in our trading. So now I'll take you to the half-an-hour time frame to figure out how we have to enter sell position. So let's go to half-an-hour time frame. After this fast move to the downside, we can expect at least 30% upward retracement to enter our position. So I have simply placed my sell limit at this 30% area, which is 1870. If you had buy position after that false breakout, which initially was not a false breakout, then you can simply wait until price reaches here, and then you can close your buy position. This is how you can lessen your loss in your buy trade. If you have already closed, no problem. So coming back to the ideology of sell trade. So here we are going to place sell limit, and now is the time to discuss where are we going to place our SL and TP, or where we are going to exit in case of loss or exit in case of profit. So if price goes to the upside and keeps going up, this is the consolidation where price should not reach. If price reaches and starts trading inside this range again, then bearish context will be almost invalidated. However, we'll have to wait for a closing of at least half hour candle above this upper border of this rectangular consolidation. So if price keeps going up and closes at least 4 or 3 pips above this rectangular consolidation's upper border, then we have to exit the trade in case of loss. So in this case, we have a stop loss from this point to almost this point, and that is 83.5 pips. Roughly you can say 85 pips. And now is the time to figure out where we will have to place our TP. I'll take you to the daily time frame to discuss the method of determining TP. So let's go to the daily time frame. Alright, we are back on daily time frame. I'm gonna remove this previous resistance level to make the chart clutter free. So we'll have to, first of all, we'll have to understand what will be the retracement against previous swing and how much will be the retracement. We have so many Fibonacci technical levels like 38.2, 23.6 is not considered because it's too small and too insignificant to take into the consideration for determining any support level. So the very first support level is Fibonacci 38.2. However, I'm not considering 38.2, but before I discuss about not considering 38.2, we'll have to find out the swing low and swing high to draw our Fibonacci. We have a clear swing high which was made at closing of August 18, that is this area, but we'll have to determine the swing low. Shall we draw Fibonacci from this area or this swing low or this swing low? We don't know. It is a confusing situation. To avoid this confusing situation, we simply have to understand that the price development always takes place either in form of harmonic patterns such as ABCD, 3 drive, bearish, butterfly, bat, or Gartley, or in the form of Elliott waves. So I'll plot something like that here to show you where we can find out the swing low. So if we had to draw a pattern here, it will be drawn like this. This could be X, A, B, C, D. This could be X, A, B, C, D. So this was previous swing low, and this would be considered as the recent swing low. This swing low is slightly higher than this one, which is why this entire movement from this point would be something like A, B, C, D movement inside this leg. So this is the swing low from where we have to draw our Fibonacci from this swing low to this swing high. This is the recent swing. Just like here, if we you will draw swing low and swing high here, you will have to draw Fibonacci from this point to this point, because this entire movement from this price level to this price level was a part of this development. It was something like A, B, C, D. Sometimes there is an A, B, C, D inside a single swing, and this entire movement was something like A, B, C, D. Alright, so now we have the swing low and swing high. So let me remove all these trend lines, because we are not talking about these harmonic patterns here. We are simply talking about a Fibonacci retracement level where we are gonna place our TP for our sell trade. So just 1 minute. Let me remove all of them. All right, chart is clear now, and we have a new retracement level, which is 35% retracement level. I have seen many times in EUR USD that EUR USD retraces to 35% level in first attempt, and it quite often it can miss 38.2 level. For example, if you look at this previous swing from this point to this point, price came down, it touched 35, but it did not go to 38.2. So the people who had placed their TP at 38.2 in their sell trades missed their TP. Therefore, in order to avoid missing our TP, we'll rather place our TP at 35% retracement level instead of 38.2. There is no huge difference. However, I have noticed this phenomena many times. I will take you to some historical movement, and I'll show you it had happened even in the past many times. For example, look at this development. In first attempt, EUR USD touched only 35% retracement level. This is the 35, and this is 38.2, and then it went up. Although it came down later, but then we could take another position after completion of this trade. So in first attempt, we should place our TP rather at 35% level, not at 38.2. This is my personal observation, and it has nothing to do with Fibonacci level. It is slightly conflicting with Fibonacci levels, but you know, we do not have interbank prices, and Forex has no exchange for a fixed price everywhere. So our swing high, swing low, and Fibonacci levels are different from the swing high, swing low, and Fibonacci levels in all other brokers and in the brokers of future trading. For example, if you look at the future trading prices of EUR USD in the brokers under CFTC regulations, you will find quite different prices. So a 2-3% difference from Fibonacci level is not a big deal. So I look at my chart, and I do what I see, what I see here. All right. So here, if you look at this swing is also very fast and long swing. Price started going up. That was a retracement against this fall, and it missed 38.2 by few pips. You can see here. So it did not touch 38.2. Rather than placing TP at 38.2, if we place TP at 35, we have more chances to hit our TP. So that's all about my observation and this 35% level. Therefore, we'll place our TP at 35, and this is 1690 area plus spread, so maybe 1691 or 1692. So now let's calculate our TP from our entry price. So if price will go to the upside, and if our sell limit will be executed here, and if 1691 will be our TP, then our reward will be something around 178.5 pips, roughly 180 pips. So this is very good trade where we have just 85 pips on the risk and almost 180 pips on the reward. So that's all about the trade. You have entry, exit, and TP level. Now you just have to place sell limit and just keep watching the trade. That's all. Thank you for watching.